listen-only mode.
Right, that was a pump fake. I now call to order the February 4th, 2026 North Carolina Capital Facilities Finance Agency meeting. Welcome, everyone. Thank you for attending. It's really a continuation of our January meeting, but we will get to that. Why don't I hand it to Cindy to call the roll?
Hello, good afternoon. Cindy Aiken. I'm Deputy Secretary Treasurer and Assistant General Counsel. And I think we're still waiting for Auditor Bolick to join. So we've got Mrs. Arnold. Present virtually today. Ms. Parker. Present in the room. I think Mr. Bowen is absent. Mr. Bowers.
Yes.
Thank you. Present virtually. Mr. McLaughlin.
Here.
Thank you. Also present virtually and Treasurer Briner.
Here.
Present. So we do have a quorum at this time. I would just remind everyone that our meeting is being recorded and will be made available to the public pursuant to the Department of State Treasurer's Recording of Public Meetings policy. Please, everyone, identify yourself when you're speaking. And if you are participating virtually, please try to mute yourself when you're not speaking. The agenda is posted to the website. If we have any changes, it will be announced during the meeting. And as is our custom, especially considering the virtual nature of most participation, we will take all votes by roll call. Without objection, your motions and seconds will be considered as a yes vote unless you indicate otherwise. In addition, we'll just mention all of our staff in attendance today. LGC Secretary Denise Canada, Jennifer Wimmer, who is the Secretary Treasurer of this agency, and myself, and we thank, as always, MJ and Lindy, who are helping us with our audio visual production. Thank you. Oh, well, sorry, Jeff Poley. I'm sorry. Director of Disaster Services and Rural Economic Development and in-house bond expert. How's that? Okay, thank you.
Wouldn't fit on my card, though. So. All right. Will you please join me in the Pledge of Allegiance and the salute to the North Carolina flag? I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of the Old Testament, pledge to be all saved, love, loyalty, and faith.
All right. Okay, we'll read the conflict of interest statement now. Please take a moment to review the agenda. Agency members are reminded of your duty to avoid conflicts of interest. Does any member have an actual or potential conflict of interest with respect to any matter on the agenda? Guess not. Okay, let's move over to the minutes of the January 6, 2026 meeting. You will see those as they were distributed. Is there a motion to adopt the minutes?
I have some comments. This is
Go
being
ahead.
number one, Benny Bowers. Number one, I think the financial advisor needs to be approved. I don't think he's approved in the agenda at this time. And the two other comments are ones that I made at the meeting and I've made previously. And that is that the interest rate in the staff analysis should read 4.83% fixed rate for 10 years. And the term should read 20 years amortization, put/tender option at 10 years.
I think this is Cindy Aiken. Jennifer, I think you can modify the
Correct.
attachment and we
Yes.
can make that. And what the first question was about approval of the financial advisor?
Yes.
Is that, I think that's part of the minutes resolution on page
Financing.
2.
I was looking at your financing team approval moving in.
We miss it. Oh. Okay. So it needs to add financial advisor.
Yes.
All right.
First try.
Got it. Who was it?
First try.
Thank you. Financial advisor.
there any other comments?
Yes, Betty Parker. Thank you, Mr. Chair. There's some language that gives me pause on the charter school financing presentation section, the last page of the text of the minutes. And specifically, if the speakers discuss the financial needs of charter schools, that clause gave me some pause because the presentation was led by Mr. Machado, who's the executive director of the North Carolina Coalition for Charter Schools, clearly a staunch advocate for charter schools and used to articulating their position. He did so here, and I had some questions that we were not able to raise before this item was approved. And I believe Director Wilson Arnold similarly had some concerns. Our discussion led us to the presentation I think that we're going to receive today, which is valuable. My concern is that the language, while accurate, since we didn't have a time for that further discussion then, might leave one with the impression that there was a need to discuss the financial arrangements of all charter schools. Our charge already includes that responsibility. Had Mr. Machado clarified that this was his discussion on this charter school, it would give me less pause. But it was more a point of advocacy that I think, in my vast experience of one meeting before that, that staff has done a thorough analysis, provide that analysis. The representatives for the previous item, I believe it was one involving Goodwill, had the financial folks here to answer any questions that fall within the scope of our typical review. This felt very much atypical to me. It felt more like advocacy. And since we didn't have a chance to pose questions with Mr. Machado and the team, leaving this line as is without our opportunity to have had input seems a bit, it's uncomfortable for me. So I don't disagree the accuracy of the statement. I guess part of my question might be, perhaps we could delay hearing the minutes motion until after we receive the presentation. That might give Ms. Wilson Arnold a chance to air the question she didn't get to last time, since we tabled that discussion. And I think my comments on it might be better placed in the context of that conversation.
Okay.
And that, if that leads to an adjustment of the language, it will be one that we have fully discussed, whether that's an addition of language that points out that that discussion wasn't had, or some adjustment here. Does that make sense?
This is Cindy Aiken. Would it make sense to add language that the directors of the agency did not discuss or have Q&A, because this reflects what happened in January, and then we can, whatever happens today will be reflected in today's minutes. Is that, would you like to offer an additional sentence or two, or?
I would
on
like
this
to
paragraph
offer
for
amended
January?
language. I'm fine if council would like to propose the specific language, or I will be glad to. I hadn't prepared it yet.
Yeah, I know. We apologize for the lateness of that draft. If I'm hearing you, what I think you're saying, I think you want to just point out that or we could say more specifically, Mr. Machado discussed from his the needs of charter schools, and the members of this agency did not have any discussion or Q&A regarding that topic.
I think that's,
Is that?
I think
that
that's
taken?
fair and reasonable.
Okay,
If it were clarified that Mr. Machado discussed the financial needs of charter schools, and I might go so far as to say generally,
yeah, that's sure.
and,
And as the
and I would
other,
say-
and the other speakers addressed legal,
And the others.
and then we can add at the end, the agency directors did not have any discussion or question and answer period on the presentation, or something like.
Well, I would say that,
enough?
I would say Mr. Machado discussed the financial needs of
Mhm.
charter schools generally, and the members did not have an opportunity
Okay,
to question that, because when the other speakers presented legal and financial aspects, we did have questions.
gotcha.
And we did have an exchange with them. Just, we did not have an opportunity to address the more general piece. I think Chair Briner did to help steer us in the direction and reminder of our charge. But to leave that lay without any questioning just leaves me a bit uncomfortable.
And maybe my word discussion, he discussed isn't the best, maybe he presented the finance, is that better?
Yes, ma'am.
Okay.
Yes, ma'am. It's without counterpoint, not really a discussion.
Yeah, he presented the financial needs of charter schools generally, and the members did not have an opportunity to discuss his presentation or ask questions, end of sentence. The other speakers presented the legal and financial aspects, et cetera, et cetera.
I would suggest discuss there since we did
Discuss.
discuss.
Yeah, okay. Thank you.
I would point out that we really didn't get to ask questions of anyone, of
Absolutely.
the under, what I will call the Baird representative, Brian, I believe. We didn't get to ask him questions. He wanted to take questions and we just didn't have time. It was going to be continued.
Right, I'm very comfortable noting that we reached no conclusions.
Yeah.
That's why we're having this meeting.
And yeah, I should have said that. No conclusions were reached, and and it was decided that the discussion would continue at the February meeting.
No conclusions were reached.
Mhm.
We continue.
Yeah, normally most of the time I keep minutes for just the specific actions taken, but in this special case, when you were getting into a sort of a policies and guidelines, I thought, well, will remember what happened in January.
I appreciate
No
that.
action was taken.
I appreciate that, and I
And
think if,
it's always your minutes as a group. I'm a scribe. So,
and I'm new, so
yeah, no,
So,
thank you for your consideration.
Cindy, while we're going to proceed with the rest of the agenda, we can come back to this. Would you mind drafting something so that we can then
yes,
have a formal statement to vote on later in the meeting?
yeah,
Thank you.
thank you.
That work?
Yes, sir, that's fine, thank you.
Yeah,
Okay.
Oh, and we'll announce also for those listening that Auditor Bolick arrived and is marked as present virtually.
So, Mr. Chair, are we
Yes.
tabling this until later in the agenda, or are we?
Yes,
going
unless there are other changes you want, I would
No,
like to formally draft something so that we can then read it and then vote on something specific.
I appreciate that, thank you.
We didn't mean to imply there were any conclusions reached. Just we need to memorialize what was discussed. So, okay, we'll come back to that. So as a continuation of that discussion, we wanted to do two things today, and I will turn it over to Jennifer and Cindy to go through both overview of the agency's authorities, responsibilities, and then some proposed financing guidelines, which were assisted by our friends at Davenport. So turn it over to you, Jennifer.
Thank you. I'm going to ask for the first presentation to be shared. This was the information that was sent out to you, and we're just going to go over this briefly, just to go and remind everybody, if you've seen part of this before, usually it's in the orientation information, but just really focus on the information that Director Parker pointed out of the charge that was kind of brought up last meeting. So to continue on with that, agency originally created in 1986 by the North Carolina General Assembly. And there is a why. Okay. So researching the why the agency was even created was to the legislature felt that it was essential for institutions for higher education and elementary and secondary education within the state to be able to construct and renovate facilities to assist citizens in achieving the fullest development of their intellectual capabilities. And the purpose was to provide a measure of assistance and an alternative method to enable these private institutions for secondary, elementary, and higher education to provide the facilities for full public benefit and good. This would lower the overall cost of education to the state and parents and students. And then also pointing out that not all of the transactions are within the education arena. The private sector should be fostered and encouraged and provides the opportunities for the state of North Carolina to aid in the activities that constitute a public purpose. So all of the transactions that are allowable under the creation of the agency fall within the reasons of why it was created with the General Assembly.
As stated in the authorizing that
Absolutely.
you were reading from.
Yes, I was reading from 159D. Next slide. So since 1986, when the agency was created, it's provided tax exempt capital financing of $9.68 billion. And the total outstanding amount is $1.22 billion. So again, each issue is payable solely from revenues derived by the entity and secured and independent, and the state or the agency is not responsible for any of those. Financings can take different forms: private placement and fixed rate public debt. The guidelines and things we'll get into in a minute specifically are for the fixed rate public debt to go and kind of give us and the directors some guidelines on what is a comfortable transaction coming through the agency. All of this debt then goes and must be approved by the local government commission. So as we pointed out, and the presenters pointed out last meeting, conduit financing, again, private entities that may not otherwise have access to the tax exempt market are given this opportunity to finance at a lower cost. The agency is the conduit issuer that facilitates these transactions. Next slide. Once again, neither the agency or the state's credit is pledged, and the underlying credit quality of the institution or transaction determines the market acceptance and the interest cost. As pointed out with the minutes discussion prior to this, each transaction is looked at on a financial viable track, and to make sure that they are able to make these debt service payments. Again, we have talked about the private colleges, university, K-12, charter schools, and then these other entities that either have or could issue debt through the agency.
I
Next.
think importantly, there's nothing in there that requires them to issue through us.
Absolutely. Next slide. So to pick up from last month's discussion, the criteria that this agency is charged to review are that the institution is financially responsible and capable of fulfilling obligations. The project is financially feasible and the institution is prepared to pay not only principal and interest, but any reserves for payment for operation, repair, maintenance of the project. Next slide. Okay. Number 3, the public facilities and services necessary for the project, including utilities, are or will be available. And the project shall be operated to serve and benefit the public without discrimination. Each one of those approval considerations are verified with staff before they come to the agency for approval. Okay. So with that, that's again the overview of the charge of the agency and its members. I would like now to go to our presentation number 2 to bring up, but I would also like to introduce and speak to the request for a third-party independent, third-party independent speaker on these transactions. Again, Davenport is the advisor to the state of North Carolina, does not do any charter school financings, but we have requested them to provide an overview of transactions of the market that would be eligible to be heard in front of the agency.
Ms. Wimmer, before you progress, Betty Parker, I apologize. Could I ask one question on your slide?
Sure.
Where the definition of conduit issuer is located? You'd mentioned that the agency facilitates tax-exempt bonds. The presentation says issues. So I think the issuing part may have been part of the confusion last time, which knowing that neither the state or this agency is responsible for payment, but is there some clarification of that language somewhere in the statute or somewhere else that makes a little more plain what our role is? It doesn't seem that we're issuing bonds, but facilitating them through approval that the criterion has been met to encourage private funding. Is that accurate?
So I am going to briefly discuss that, and then I'm going to turn it over to Jeff Poley, who is bond counsel by trade, to give the legal definition. But yes, the agency does approve, but then they have to act as the issuer because there is no way for that entity to then have an issuance tax exempt without a issuer. So, Mr. Poley.
Yes, the IRS in its wisdom or lack thereof says for 501c3 and other type bonds, a governmental entity has to issue the bonds. And so when for all the four, well, you approved the one when you were here last week. There was actually the agency issued a bond, private placed bond to, I forget which bank it was, Pinnacle Bank, for goodwill. Now issued means Jennifer and Cindy signed the bond and handed it over to the purchaser. It also means that the conduit issuer had to file an 8038, tax forms and so on. So you do actually issue the bond, just as, say, Wake County would issue bonds for schools or so on of various types. But yours is a revenue bond payable only from the revenues of the borrower or otherwise. So does that help?
Bottom line, isn't it just the fact that in order to get tax exempt debt, they've got to go through the state, and the agency was created to do tax exempt debt, first for educational facilities, and then it was expanded to other entities, nonprofits, et cetera, et cetera. But the fact of the matter, it's a way for somebody that didn't have a way to get tax exempt financing to benefit from it. A conduit could be without any requirements, pay and I'll issue whatever you want, or a conduit can have its requirements that it wants for issuing. And that's one of the differences between Wisconsin and North Carolina.
Thank you.
Okay. So I'd like to introduce the advisors, which Ty Welford and Jimmy Sanderson. They will be going through just a couple of slides as a general overview of this, the market and guidelines that we're about to discuss.
Thank you, Jennifer. Nice being with you all this afternoon. As Jennifer mentioned, we are acting as municipal advisor in the Mid-Atlantic region. We do specialize typically in governmental, local and state government financings. We do some work in the higher ed space. We do not work in the charter school space. And so we were tasked with trying to pull together a couple of brief slides to provide perspective on credit ratings generally, how that's evolved over time, municipal default rates kind of across the public finance industry, and give you all a little bit of just factual information on that basis, default rates by rating category, as well as kind of the evolution of credit ratings over time. So if we can flip to the first page, a lot of information on this page, but what we did was we have access to some good information from Standard & Poor's, which is one of the 3 major rating agencies that are out there. And what we are highlighting here, S&P has a lot of good information on public finance defaults that have occurred since 1986. That's when they started tracking it, at least for purposes of the reports that they put out. And so what we've tried to summarize here by different rating categories on the left side is the number of defaults that have occurred, both based off the initial issue rating as well as the final issue rating right at the time the default happened. And so since 1986, roughly 40 years, there have been 139 defaults as rated by S&P at least in the public finance space. And this covers everything: state, local, education, transportation. It does not include housing, but it basically includes every other sector. And what you can see here at the top left, the number of issuers that have defaulted by their initial rating is honestly pretty well distributed. And for those that aren't familiar with the rating scale, the credit ratings go from AAA down to AA, single A, then it goes into the BBB category. And after BBB, that's historically, that is the end of the investment grade category. And then you start getting into the high non-investment grade, which is BB, single B, and then C's and D's and so on. And so you can see from the top left chart, at least our takeaway was pretty fairly distributed in the investment grade category all the way up to AA, with most of these entities in that single A to BBB category, a couple in the BB category. However, as you look down below it, at the time that the issue actually defaults, the rating on that bond at the time is typically well into the speculative grade category. And you can see a pretty high concentration in that CCC and CC range. What we've then tried to give some perspective on in the tables on the right first is just S&P's current distribution of ratings across all U.S. public finance. They currently carry about 21,000 ratings Most of those are in the, call it double B and higher category. And then next to that, we're showing, once again, based off S&P's tracking, the historical default rates by these rating categories across time. And I'm sure you all are aware, but the default rate in the US public finance space historically has been extremely low, as evidenced by there have been 139, right, of S&P rated issues that have defaulted over the last 40 years. But this is tracking it over a 10-year horizon, right? So it tracks the life of each issuance over a 10-year period, and it shows the cumulative default that happened as issues fell into these different categories. And so AAA, 0, hasn't happened. AA, 0.03%. And as you scan down, you can see those numbers start to pick up, especially as you get into the single B and then the triple C and below category. But in total, it's about 0.24% of all issuances. As you go across the spectrum, you can see the different figures shown there next to those main rating categories. Let me pause there, see if there are any questions.
If I may.
guess I do have a question. From an issuer standpoint, I'm thinking, what's the default rate from when we issued it? We know it's going to fall as if it starts deteriorating, just as anyone would. It's important to me to know how many bonds that were initially some rating eventually defaulted. And for municipals in general, as you have pointed out well, it is very, very, very low for a investment grade issue to fail. It is extremely low. In yours, you're showing triple B ready to be less than 1%, and double B to be a little over 4%. Is that correct?
That's correct. Yes, sir, Mr. Bowers. And I mean, to answer your question, we're putting some different data points here because we're kind of looking at a multifaceted topic, right? The initial rating, the final rating, the spectrum through the rating categories. But to your point, in terms of what percentage of issues that were originally rated in a certain category that ultimately defaulted, it's kind of taking that top left chart in the lime green bars, right? And you kind of weigh that against, it's not a perfect answer, but you can get a sense of how many rated entities S&P currently has, right? So there are a number, it's almost evenly balanced, single A, triple B. There's no real, at least from our reading of it, meaningful takeaway from the lime green bars. They're a low number, and in the context of the overall number of entities rated in those categories, it's an extremely low percentage. What realistically happens is something starts out in one of these categories, and then it ultimately evolves down into triple C when there's a problem identified, and then the default occurs at that point.
I would just also note, I worked with Davenport on this. Unfortunately, this isn't not on computerized data that we can slice and dice the information the way we would have liked to. It was a 94-page report of just numbers. And so unfortunately, I said AI, S&P could sell a lot of data through AI, but we couldn't get as granular as you may have liked just because of the presentation. And Ty and Jimmy may want to speak more to that. I don't know.
All right. Jimmy, anything else on this page? Yeah. If we could flip to the next page, very brief presentation, 2 pages. This is just to give some context of a development we have witnessed as market participants over time, and specifically within the last 10 years or so. And this is simply noting the prevalence of non-investment grade paper coming to market. And so what we're highlighting here, once again, this is S&P credit ratings, but you can see specifically in the double B category, which is the first major bracket below investment grade, below triple B. So this is double B plus, double B, and double B minus. The number of issuances in the public market with an S&P rating, an initial S&P rating in that category. And the dark green bars are double B plus, lime green are double B flat, and then the brown color on top is double B minus. And so the takeaway, once again, our takeaway here is activity is certainly picked up. If you took this graphic even farther back, you'd see, between 0 and 5 for most of the years before that. But really starting in 2015, that has picked up, especially in that double B plus and double B flat category. Some of that is the growth of charter schools. Some of that is also the growth of some of the higher ed participants in that category coming to market. But just once again, some market intel about the prevalence of, non-investment grade paper. Historically, a lot of those issuers were still coming to market. They just would have come to market as a non-rated entity. And so the investor community is finding some value in those ratings as demonstrated, by this graphic. At least that's our takeaway from it.
I would ask a question. It's about I thought it was going to be focused on charter schools, and it's focused on everything the agency does. And in looking at charter schools, at least about 50% of the paper was going non-rated and 50% was going rated. And there was somewhere I got the idea that there was a significant difference in the default rate between those that didn't go with rating and those that did get a rating.
That is not, that's not something we have access to in terms of the data here. It's an interesting question. Unfortunately, don't have any data points to point to related to that.
Okay.
If I may ask a quick question, sir. I think it's building on the last question. Is it a reasonable presumption that an unrated charter school, if rated, would be non-investment grade? Are we presuming that simply because they're not rated, it means they're non-investment grade if they were rated?
Ms. Parker, it's an interesting question. I mean, I think tangentially from what we've seen here recently in the market, the kind of threshold we've heard, once again, this is not specific to charter schools, but other areas, that if you can get a credit rating that's in the double B plus range, there is more value to having that rating versus having it non-rated. If it's going to be lower than that, then it may be better off just to keep it non-rated, although it is more challenging typically to sell paper in that front. I mean, 10, 15 years ago, that, once again, this is us going a little off script because it's just our experience, but that threshold tended to be the investment grade line, where if you were below investment grade, you would just keep it in a non-rated mode. Jimmy, do you have anything else to add on that?
Yeah, no, I would say that's absolutely the case. I mean, Mr. Bowers probably remembers this too. I mean, the general rule was if you couldn't get investment grade, just go non-rated because there wasn't going to be a pickup in a lower interest rate in that double B category. But we're certainly finding that underwriters are telling us, and investors are proving it out, that they will purchase paper in that double B category, and there is an interest rate pickup for the borrower, meaning a lower interest rate that would bring.
And Dr. Parker, to your question, there are investment grade rated charter schools, both inside of North Carolina, some at the
first deal since Treasurer Briner took over was a triple B minus deal, but it went a bank deal. You know, they have much better access to banks and so on. But so there are North Carolina rated charter schools. They, because of the 15-year hiatus of the agency being really active, I don't know if it's come out, but and then in other states they have credit enhancements for, you know, Texas might say we're going to throw in some intercept program to make them AAA, and so, you know, AAA or whatnot. So there are AAA rated schools, and there are some that go through PFA. There's some that do not.
Right.
So there, I mean, not AAA, I meant investment grade charter schools. So
Where's that decision?
So I think I would ask the question, even if they were double B, don't they normally benefit by get a lower interest rate by having a rating versus not pursuing it?
yes,
So where is that decisioning point to decide whether to seek a rating or not? Is that incumbent on the charter school
it,
or the bond council
it
advisor?
is generally the charter school in consultation with the FA and the underwriter, as Director Bowers has pointed out, and I think it implied by the Davenport, is that if you don't think you're going to get, sometimes rating agencies give you a free look, say, we look at you, you're not going to get it. So don't spend the $25,000 or whatever it is to take a rating, to get a rating, because you're not going to save the money. But if you can get a double B, it's worth the money over time, which will be demonstrated in a bit, to get that rating. So well, I guess it won't directly be over time, but in the next slide, but we have an example. So
Thank you, that's very helpful.
So I want to make sure before we transition to the guidelines, which kind of continues the discussion that Mr. Bowers brought up about the requirements can be different for conduit issuers. The guidelines that we are going to present to the members are what we are asking for, like to make sure that, and I think you almost had a question of where is that line? Where is the line? Is it the issuer? Is it us? We want the the agency to give staff at least a line to start with, to then, if they don't meet those guidelines or criteria, then maybe it's better off that they go to the Wisconsin PFA or, you know, find a bank placement, but have some kind of guidelines to make sure that the agency is not only knowing what kind of credits are coming to be presented, but also there is kind of oversight that we follow up for annual reports and things like that. So we know the credits that we're issuing. So I just want to make sure that everyone got their questions answered.
Ms. Arnold has
Oh, okay, Ms. Arnold?
Thank you. Treasurer Briner, thank you so much for bringing forth the Davenport group and the information and the work that you've done to this point. I've got two questions or streams of thought here. One was about just counsel on institutions, organizations with no ratings. And I think the Davenport group has addressed that in terms of their response there. And the other one was around where the line is if we were developing that. So it sounds like we're going to get some guidelines or a recommendation for some guidelines from the agency around that. My second question, though, is, can you talk a little bit about how and why the conversation around below investment grade is centered on charter schools instead of all of the other types of entities within our scope?
sure. There have probably, I'm guesstimating, been 50 to 75 charter schools financed in North Carolina. I don't know the breakout of rated versus non-rated, but and the reason will be shown. a lot of the YMCA's and the other entities that come through are simply not the type that would go out and get a rating. They have a local bank that's ready to give them money. For example, Goodwill, they have 15 banks lined up to give them money. So it's what they do, and some are just not the type of things that would get rated, period. But there have been probably 50 to 75 charter schools in the state of North Carolina that have gone out for financing. Nearly all of them have, some of them started out here and then refinanced into PFA for various reasons. Some of those are rated, some of those are double B, some of those are double B plus, some of them are non-rated. So the charter schools, they are the topic right now. I mean, we tried to make it general in case an industrial pollution control, an industrial project came. But charter schools are the people who are knocking on the door. And private schools, Grace Christian Academy in Cary just issued $100 million worth of bonds. They didn't think they were going to get triple B rated, so they went through PFA. They ended up getting AAA rated bonds. That's a private school that got an investment grade rated. There's probably several private schools in Charlotte that are going to be somewhere into the investment grade or not investment grade ratings. So we were trying to avoid this specifically on charter schools because that creates obviously some politics that are unrelated to the financing, and that's why we're trying to focus on it's a financing issue, not a type of school issue.
But that said, right, just
Right.
to be clear, if we change this policy, you should expect the vast majority of people who come because of this change in policy are charter schools. Just the nature of the schools themselves. Private schools have a very diversified revenue stream in every individual student, right? Charter schools have a single source of revenue, generally speaking. That is a natural credit downgrade, essentially. So
Is it
if we
true
change-
that
Right,
Benny
if we
Bowers.
change this policy, you will see charter schools. And so we don't want to pretend that it's something else. That's why we wanted to talk about that specifically.
I really want to consider on a policy, if I can just clarify 1 second, Mr. Bowles, really quickly. I think what we're saying is, and tell me if I'm wrong, while the conversation is centered on charter schools, we're not recommending a policy that would be limited to any one entity type.
Correct.
Thank you.
But we also don't want to surprise you that that's who would be the issuers mostly at the double B level.
I've certainly noticed that in terms of our recent discussion as well. So thank you.
Right. The people who call me or call Jennifer to say what's up at the agency, it's nearly 100% charter schools, and then other folks that say, hey, we used to have these local IDB authorities. Can you now do it through the North Carolina Capital Facilities Finance Agency? Because I don't want to go into history, but those small, what we call IDB authorities haven't been in existence for 30 years. So, but anyways.
So as an example, if we have a private university who has let their ratings lapse, would they come back through under this policy rather than going through the additional time and expense of rating?
Yeah, well, I can give you an example. Methodist College is a double B plus rated entity. 5 years ago, we wouldn't have done this. That was the guideline. They went through PFA. Now, if they had to do it all over again, they probably ask us to do it because of the interest rate savings that are going to be shown in a little bit.
And if my abbreviated internet research is accurate, Elon University dropped their rating a number of years ago. So if they come back through, they would benefit from this, could benefit from this process, or seek a rating as it may benefit them. It provides choice.
If they want to do fixed rate public debt.
Right.
Elon's in a sweet spot in that they usually borrow for student loan projects, and they are earning much more on their student housing than they are paying on interest. So they don't have to get a credit rating because the bank's willing to, we'll give you that money.
And we'll get into that just to make sure that we can have time for the guidelines. But yes, the ratings and anything associated with ratings are for the fixed rate public deals only.
I would like to make two comments. One, with charter schools, and Treasurer Reiner, I really appreciate you noting that the majority will probably be charter schools at this time. But what you're doing is looking at a universe and trying to find the strong credits in it that are capable of doing a long-term financing. 30% of all our charter schools chartered to date, 94 have failed. 218 are operating, 94 have closed their doors. You can't finance them all without having, a 30%. It's hard to finance something if you're closed. You've got to find the ones that are capable, and startups. The first 5 years are tough,
Right.
And
Yeah.
so you're looking for what can repay and how can we benefit those that can, in my mind.
It is absolutely a nuanced conversation. I completely agree with you. And I think it would be useful to get to the example of a real double B
Ms. Arnold, that's the
who's
first.
coming in front of us, if we can. But Ms. Arnold, do you have another question on the general topic before we get there?
Just another quick question. I'm happy to take this offline as well, but just in this conversation, first of all, again, Chair Briner, thank you so much for bringing some activity to the board. I've been here for a couple, not been quite as busy, so I appreciate it. I had to really dig in and understand what we're doing here. But it did make me think about, in preparing for this meeting, if we do any measure of outreach to make organizations within scope aware of the opportunity. What is that like as it relates to awareness and culture? Do we do outreach? Is it appropriate to do outreach? And again, I'm happy to take the conversation offline as well, because I do have some other questions that I'll be following up with you all on.
My view, and feel free to add on, is that the financial advisor and the legal communities are so tight and well networked with each other that when and if we make a change, it will be disseminated through those networks very, very quickly to the end potential borrowers.
There are people listening on this call awaiting the decision because their clients are going, or school will go one way or the other because they're waiting for this decision.
Okay.
Very good.
Thank you. I would like now to go into the presentation of the guidelines and the scenario case, just to give everybody some information. So both the Davenport presentation and these slides will be provided to the members as soon as this meeting's over, so you'll have that in front of you. But we have asked for a scenario where this is the same borrower. So if the borrower came to the PFA, double B is their assumed rating, same maturity as that they would be asking for here. The par amount is given as 28,150. If you notice, if you go across, the par amount is less. It's 28,110, and that is because the borrowing cost of issuance, they would not take out as much. The debt service, it goes across and then the interest cost savings. What we have asked is as this hypothetical example, is the consensus around the underwriting community that would be placing these fixed rate deals is that going through the North Carolina Capital Facility Finance Agency would be a savings of between 15 and 25 basis points. Of course, it could be more, it could be less, but average is what they're seeing from not only the issues that have gone through PFA, but other conduit issuers, within North Carolina in different sections that don't come through the agency. Medical Care Commission, other conduit issuers. So we wanted to compare what we have. We do not have, as the agency, any examples, but from the consensus of outside underwriters, they are seeing that and predicting that just going through the agency, everything else the same for the same credit, that the borrower, whoever it is, would be saving between 15 and 25 basis points off the top going through those agencies or going through the agency. Next slide.
Before we, just to, the third from the bottom is the important row to me. Like, there's $1 million that we are asking essentially of our double B borrowers by making them go to Wisconsin right now, up to $1.7 million. And this is, in my view, going to happen anyway, right? They're gonna go to Wisconsin. They are, we see it. Do we think that it's worth charging them $1 million? Is how I think about this conversation. We also have a duty, and we're going to come to the guidelines to make sure that we protect the reputation that's well earned of the state as a creditworthy borrower in everything we do. And so can we do both? That's the real question in front of us. Can we save our issuers a lot of money that is unnecessary and preserve that reputation? I think the guidelines that you're about to present do that, but it is a board, so we all get a vote.
Yes. Okay. Next slide, please. So we wanted to point out, again, all of the discussion on ratings and where this falls is only in particular dealing with the fixed rate bond deals. So to let everyone know, the bank purchase debt that has been through the agency or will come through the agency, there is no change to that. The guidelines that were set out, the taxable takeout loan concept, it's in the legal documents, which means if that entity ever loses its tax exempt status or, goes into a default situation, that tax exempt loan issued by the agency is then paid off and we are out. The agency is out of it and the borrower and the bank will work out their tax exempt or their taxable loan between those two parties. And the agency would then be out of the transaction altogether. Not that the agency is responsible for that, but that is the language that is in the bank documents for those loans as a protection. So we wanted to continue the protections for the fixed rate market. Again,
Wait a minute,
as-
just a
as-
second. What you're doing there is those are the way most of the non-rated bonds are being handled now. They're not truly fixed rate. They're fixed rate for, usually the bank will only go 10 years and you have a 20-year amortization. They actually have more risk in them than a fixed rate because of that tender. You know what's going to happen after the tender period. But it's the way to handle non-rated debt. Somebody wanted to go non-rated and a bank is willing to take the risk. And that's the way it's being handled today, I believe.
That is correct, and nothing would differ from that. So again, with the market having increased as the Davenport slide showed over the last 10 to 15 years, more and more entities are going to the public fixed rate market. So in order to have some guidelines that the staff can start with when we have an entity approach us is we are looking to present these potential guidelines and have a discussion on that. So we've thought about the rating and where that line would be best. So borrower rated in the double B plus double B category or better by S&P, and then and Fitch, or the double B1, double B2, or excuse me, BA1, BA2 categories by Moody's. So that's the rating line that we're looking at. And that's based on the information that was provided on the defaults and where those categories kind of line up. The longevity, to Mr. Bauer's point, a lot of the defaults have occurred with the new startup entities. So the borrower needs to be in operation for more than 5 years. In essence, no startups. The reporting, the borrower agrees to certain reporting requirements in respect to its operation, quarterly financial statements, annual audits, enrollment, waiting list reporting, and charter status updates. All of those items are currently requested and needed for a regular application. So what this would do is have ongoing reporting requirements for these credits. It is in the documents for each transaction that the unit provides their annual audits already, but this would go a little bit deeper into that. Feasibility, the borrower has a third-party feasibility study regarding its financial projection, and this is for sub-investment grade only. Again, it goes to Mr. Bauer's point on the bank. For the bank deals, they have decided that credit is good enough that they would lend them that money. They have credit analysts working for the bank. This would actually give a third party, so not the agency, not our staff, but third party feasibility that yes, what their projections are saying is that they are financially feasible and have the wherewithal to pay for this. In terms of investor criteria and bond denomination, so for the sub-investment grade transactions, the investors will be limited to qualified institutional buyers, and the denominations will be no less than $100,000.
And for those who are familiar with the QUIB term, that's $100 million in net worth or above. So sophisticated, very sophisticated investors.
Correct. So therefore, protecting smaller investors, they are not allowed to own this type of debt. So what's usually called credit enhancements, mentioned insurance. At one point that was a means in the market, but the debt service reserve fund, the bond documents would require one, and so that would protect against short-term cash flow problems. What that is, if you're not familiar with that, is that basically there would be a reserve fund that in case the bond payment, they weren't having the cash flow to make that next bond payment. They would have set aside funds with their trustee so that that bond payment could be made. They would not default, and it would give them, 6 months to a year, depending on when the payments are due, to look at, okay, the cash flow, and they would not automatically default is what a debt service reserve fund is there to prevent.
Is there a specific amount or number of payments or percentage that's going to be set up in this? It's typically set up.
Yeah, it's usually,
It's usually determined by tax law, but and I don't know what's standard in the industry. It's usually either the average debt service payment or the maximum annual debt service payment that is borrowed. Now, some issues may be less, some issues may be more, but you cannot borrow under tax law more than a certain amount for a debt service reserve.
Is there a criterion or level that's going into this
But
review? And
I don't think we've gotten that far. But
are we considering doing that as the evaluation progresses?
yeah, well, the market,
dollar amount would be based on the market and the
Yeah.
transaction. But again, knowing that a lot of the other conduit issuers, they include the debt service reserve fund, there's a very easy way for per transaction to figure out what that dollar amount is. We just wanted to make the criteria that it would be required.
Right.
That because there are some transactions that it's not required, that they don't have to have that. But in order for more credit enhancement and insurance for these transactions, having a debt service reserve fund would then have a little extra protection on them making their payment and not defaulting because of payments.
Right. And the market as identified by the financial advisor / underwriter usually determines how much you need to put aside. But for these sub-investment grade credits, it's usually required by the market that you have something because they're taking risk too.
I think it's also required often by, well, I will call investment grade issues as well. It's not an uncommon feature. I am curious about the feasibility. There are at least 3 types of feasibility studies that I'm familiar with. The lowest being agreed upon procedures, the next advancement being a compilation, and third, a full feasibility study. What are we looking for in terms of feasibility?
Benny, as we discussed, the third party, the full feasibility study that I think you're typically looking at, but that you are used to seeing. If those who didn't know, Director Bowers was with the LGC for I don't know how many years, but he worked on a lot of these transactions, so knows a bit. But we are looking for a third-party feasibility. I don't know if it's going to be 50 pages or it's just going to be, whatnot. But it's not going to be agreed upon procedures because I know what you mean by that. In that, someone puts out projections and an auditor says, oh, that's okay. It's going to be a third party going out individually and saying, what is the projections?
Okay, that helps. The next question that I have that as much as anything else, just for everybody for me to understand is realistically, right now, the agency has 0 defaults. And the probability of default in any municipal issue is very, very small. And right now we only do 2 types, investment publicly or a bank placement, whether it begins and ends with the bank. What we're talking about here is opening up to some level of non-investment grade, speculative, let's say, to be placed with a qualified institutional buyer. That includes mutual funds. I believe that probably, I know that when Bard referred to it, he referred to Vanguard, Nuveen, and BlackRock as some of the mutual funds, but I believe the primary buyer of these is probably a mutual fund who can buy the whole thing or a huge, probably the whole thing, but maybe not. But at any rate, he will turn around and participate it out to individuals and entities, might be an insurance company that's in North Carolina who can benefit from the state tax exemption. But basically, you're going to be selling to high yield. I think you're going to be selling to high yield mutual funds who will participate it out. Is that correct?
Benny, from my experience, I don't know if, well, first of all, there's really no high yield debt in the North Carolina, so I don't know if there's a high yield North Carolina fund, or is it just going to be taken by Vanguard and hedged against the AAA rating of the state or whatnot? But yes, you're probably, we're thinking the reason there's going to be that interest rate difference between PFA and North Carolina is the North Carolina tax exemption and the good stewardship of the state of North Carolina vis-a-vis PFA. They know we don't approve debt just because the check cashed.
Yeah, I'm supportive of every action that you're taking to try to ensure the financial feasibility. I'm just wanting to say what's likely to be.
Oh, I'm sorry. I thought there was a question in there. Yeah.
Okay, and the auditor has a question.
Yeah, I guess my question is, it's sort of related to both combination reporting and investor criteria, and looking for maybe some guidelines in terms of adherence to mission. Here on the reporting guidelines, you're talking about enrollment numbers. Those are just data points, adherence to the public mission, because charter school, for example, another entity that was utilized as a facility could take a tack and a left turn. Like on the report, see something with respect to, or like to hear pros and cons of something with respect to adherence to public mission.
Absolutely, we can add that to the reporting requirements. Again, it would kind of go with what we already have with the tax exempt, status. But we can add that to the reporting guideline.
One quick thought, Auditor, is I'm guessing all the charter schools have to report regularly to the DPI or Charter Review Board. We can make them CC us on those
That would be,
reporting.
yeah, that'd be helpful. Yeah, because it would be, particularly in terms of at the issuance stage, what is your graduation rate? I mean, are your prospects continuing? Those type of metrics that show an adherence to mission.
Yeah, and when push comes to shove, when we do issue these bonds, there will be something called an official statement with an Appendix A, and it does have a lot of the information that you are asking for. It's for the initial buyers, which includes the letter grades of the schools. It includes the wait lists, which are pretty much the most important things I think investors look at. Because if they have a long wait list, that shows that it's a needed school. So, but yeah, all that stuff can happen.
Can I interject one quick point? I appreciate the reference to DPI's collection of data. Unless I'm mistaken, charter schools don't report their enrollment at the start of the year as the public LEAs do. They report it at the end of the year. So their data is in arrears more than current. Or at least that was my recollection from my interaction with long-range planning in my last career. So to the extent we're relying on DPI data, the timing of that might be important. And it sort of leads into another question I had. Ms. Wimmer had mentioned that if they become if they lose their tax exempt status, the agency is out and it's between the lender and the borrower at that point. What happens, the gentleman mentioned earlier, the number of charter schools that have failed. What happens if their numbers go down to where this sort of, in effect, in-house rating we've applied for sufficiency is no longer met? Is there a mechanism there that triggers that same sort of withdrawal of the agency from the process?
From a determination of taxability calls, you do see those often in the thing. If the school fails, it's just like any college in the state that we've issued bonds to, whether it's AAA, AA, BBB, it's a default. They fail to make that payment.
So irrespective of failure to make the payment, maybe I'm grossly oversimplifying this, but agency staff is becoming an internal rating agency to determine a minimum sufficiency or consideration, right?
Well, I think part of this is to take us somewhat out of that and instead of just using banks, having a rating criteria rather than saying non-rated. But I don't know if, does that make sense? So
By definition, they're going to gone through a third-party rating agency to get to this step. So we will not be acting as a rating agency, just to be very clear.
But we've provided a clear guidance and process for how to deal with the unrated that come before us. And if
They don't. Non-rated is not.
I'm good on that.
That's below the line that this is giving you. This is double B plus.
So,
They have a rating.
so this is dealing with those who are rated at double B and above. So those that are unrated, this would then close out of that process.
They would,
By
if they would
applying
have
this
to, if they
guidance.
wanted to come to the agency and they were unrated at that point, they could do a bank placement, which then goes to the bank credit and everything like that. But this is for the fixed rate deal that the line, if they are unrated, they do not come here for a fixed rate.
Okay, so we're drawing a line for the unrated. That's not going to be something that's handled for fixed rate.
Correct.
This is only for those that are considered below investment grade. And how that works.
Right.
That's the real point I wanted. I got confused between the non-rated. This is for those that are below investment grade and rated.
Yes.
Unrated.
It's not to open it up to any, that's what the guidelines, we wanted a line to say, in order to come through the agency to issue fixed rate debt, this is the line.
So to follow up on my last question, if one of these that passes muster under the criterion, double B or above, and goes through this process, if they lose their tax exempt status, we're out.
Yes, on a fixed rate deal, there would be called a taxability call.
Okay,
Yes.
what happens if these reporting requirements are no longer met? If we're looking at these numbers and these numbers no longer measure up, does the rating agency diminish its rating? And if it falls under a certain rating, does that trigger the agency withdrawal of support?
So two things. So we would get the information we are requesting, but if they have a rating, they also have to report things to the rating agencies, and that is their rating would be affected differently if the rating agency so sees fit. If the guidelines that we're looking for, we would be following up. We would probably be taking that information back to the agency members as status reports on that. But the rating agencies are looking for certain metrics of their own that they would be asking the borrower directly.
So is there any sort of automatic stop if they fall under the minimum rating?
There would not be any automatic thing. We just, if they fall under the rating, there's really nothing the agency could do. Just,
Would it not fall back? Would it not fall back to the bond documents? And it's common to see covenants, days cash on hand,
yes.
whatever you have, whatever was required in order to get that rating that causes a breach, that causes someone to have to take some action to address that issue.
Yes, we would, that by getting the information, we would be saying, and S&P would be saying, you need to get your days cash up on hand. There's, I don't want to call out the college that had some issue before, but that's what happened is we called and said, are you aware of this? But ultimately, if there's a default, it's a North Carolina, the Capital Facilities Finance Agency is defaulted. We're at the same risk. It's just, we're getting a little bit riskier by moving the line. And it goes back to what Treasurer Briner said, how much are we making our schools or borrowers pay for that risk?
So it looks like we are running low on time again. We were not anticipating voting on anything today anyway, so we can continue this discussion anew. I do see two hands raised virtually, so why don't we do those two questions, move to the minutes, and then adjourn if that's okay. Ms. Arnold, I see you have your hand up.
Thank you, Mr. Treasurer. I appreciate the points of clarification. I think my lines of questioning were the same as Mr. Bowers and Ms. Parker's, which is, it sounds like these guidelines are specifically for entities that have a rating, and we're not going to consider low investment grade entities that are not rated. Is that correct?
Correct.
Okay, thank you for that clarification. And then I would ask the staff to consider that because we are now considering below investment grade entities, if there is some additional reporting requirements that we should always also be looking at, whether we can take action or not. It seems like there may be a need for additional reporting requirements or more timely reporting requirements beyond the standard that we currently have. Thank you.
Thank you. Auditor Bullock, I see your hand up as well.
Yeah, I'm sorry. Just one quick question, whether there was, as part of Davenport study, was there a look at and I know it's an overall risk and maybe no way to answer the question, but overall risk profile of the actual likelihood of the continuation of charter schools as an entity in the state of North Carolina. The creatures of statute, and every time the legislature meets, they can certainly change the law. And so, issuing debt long-term, I'm just wondering what that risk profile, or if there is one, may not be able to calculate that.
Yeah, Auditor Bullock will just mention that was not something looked at specifically, but I think that speaks very well to Treasurer Briner's point about why charter schools tend to fall lower on the credit rating spectrum because of the risks that are inherent to the setup of those as credits.
Okay, why don't we finish that discussion there? What I'd ask everyone to do is think about the guidelines you've just been presented, think about how they can be refined, communicate to staff any questions, any edits. We will convene when we have other business next, whether that's next month or month after, I don't know. We'll leave it to you guys. And then we can be in a position to have a more fulsome discussion and even entertain a motion at that point on this matter. But we need to go back to the minutes. So do you have a
Yes.
motion that you want to?
Technically, we don't have to approve the minutes
Would be
this
good
meeting,
to.
but we can. And I don't know if MJ can share it on the screen. Oh, there we go. Okay, if you could kind of blow that up. I don't know if it's big enough. Yeah, but I can read. So the change was, Mr. Machado presented information on the financial needs of charter schools generally, period. Ms. Williams and Mr. Kelso discussed the legal and financial aspects of conduit tax-exempt bond financing for charter schools. Due to time constraints, and added something, the directors did not get to discuss the presentation or ask questions, and the directors decided that additional information would be presented at the February 26th meeting, allowing for more time for discussion and questions from directors.
Parker, does that work for you?
It does, and I would make a motion to approve it with the suggested amendments.
Yeah, and the other two amendments are Mr. Bauer's additions on the exhibit, modifying that terms, and the adding of financial advisor approval.
So that's my motion with those edits as well. So
Yes, sir.
all right, we have a motion. Is there a second?
A second.
Thank you. Call the roll, please.
All right, the minutes as amended, motion Parker, second Arnold. Auditor Bullock,
Aye.
thank you. Mr. Bowers,
Yes.
thank you. Mr. McLaughlin,
Aye.
and Treasurer Griner.
Aye.
Thank you. Motion carries.
So then the final remaining order of business is a motion to adjourn. Do I hear a motion to adjourn?
So moved.
Thank you, Ms. Parker. Is there a second?
Second.
Thank you. We'll do this by voice. All those in favor, say aye.
Aye.
Anyone opposed? All right, we're adjourned. Thank you, everybody.
Mr. Chair.